Okay, guys, today is our lecture number 4. This is the lecture number 4, and we have started IFRS 15 revenue, and today we'll discuss about the methods of measuring or the progress toward the satisfaction of performance obligation. So let me explain it here first and then we will read it out. Clear? Okay. The topic today is methods of measuring progress toward satisfaction of performance obligation. So we have two methods. The first one is output method and the second one is input method. The output methods is basically the progress usually based on the goods and services transferred to the customer. So it means that it's considering the output means the completion that has been transferred to the customer. And the second one, which is called input method, in this method the progress towards satisfaction is based on input. By input we mean the cost we incur based on input used to satisfy the performance obligation. Clear? So when you are calculating the percentage of work completed, then you will do completed work to date, and then you will divide it with the total work. So after doing this you will get a percentage of work completed. This is called output method. And if you see here, if you want to calculate the progress towards satisfaction after using input method, then you have to calculate the percentage of cost incurred. This is your input. And how you will calculate? You will take the cost incurred to date and then divide it with the total expected cost and multiply with 100, then you will get a percentage, and that percentage is used for the revenue recognition. Clear? Now what you will do, the progress towards satisfaction is not measured reliably. So if it is not measured reliably, then you have to use the cost incurred, and that is recoverable. You have to recognize the revenue only up to the amount of recoverable cost incurred. So in case if you are unable to recognize the progress toward the satisfaction, then you have to use recognize that amount, that cost which has anchored but is also recoverable. So recoverable cost anchored should be recognized as revenue. Clear? Now let's check what we have written here. You see here. Now the methods of measuring progress towards satisfaction, performance obligation, we have classified as two categories. The first one is output method, and this method the progress is based on the values of goods services transferred to the customer. It means that the completion which is transferred to the customer, that should be included is an output method, and it's a concern about that. Now example is a survey performances, time elapsed, and recognized revenue based on the passage of time in long-term contract. So here we have example. If you see here, let me zoom it. Okay, here. Yeah, this one. You see here. Here we have a construction company is building a bridge. Okay, now the contract specifies that revenue is recognized based on the number of section of the bridge completed. So this means that the contract, they are using the method of output. They're using output method for recognition. Means that you have to recognize the revenue from this contract based on the number of section of the bridge completed. So contract price is this one, the total section to be completed is this one, 10 section, and section already completed 4. So how you will calculate the percentage of the work completed? You just take the completed to date amount, and then you have divided by the total amount and multiply with 100, then it means you have completed 40%. So when you are recognized the revenue, then you have to multiply this completion percentage with the total amount of the contract, and then you will get a recognized amount of the revenue. Clear? This is called output method. Okay, now another method is called input method. Then this method is based on the input used to satisfy the performance obligation. By input we mean the cost anchored. Okay, and if you see here an example here, that a software company is developing a custom program for a client. You zoom it. Okay, now revenue is recognized based on the cost anchored as a proportion of the total expected cost. So this means they are using the cost anchored. It means this is input method. An input method, what you will do, cost anchored to date divided by the total expected cost multiplied with percentage. Okay, so contract value is this one, expected cost is 100,000, and then cost anchored to date 400,000, and so percentage of the cost anchored will be that 400 divided by this amount. You will have 50%, and this 50% multiply with this contract value, and definitely you will get this amount. This is your recognized revenue. Okay, we have already talked about that if this and the progress cannot be measured reliably, then what you will do, you will have to recognize revenue only up to the amount of recoverable cost anchored. In such a case, revenue is limited to the cost anchored to date because it is not possible to estimate the revenue with a reasonable degree of reliability. So in this topic, we have the key point, and the key point is here. You have output method, input method, and if progress is not measured reliably, what you will do. The output method is based on the outcome you have achieved in the completion. By input method, we have the progress based on the input, mean the cost anchored today. And then it is not measure, both of these not give the reliable measure about the progress toward satisfaction, then you have to use the recoverable cost anchored as a revenue. Clear? Now here we have a question, and this question is B. Okay, here how should Becker account for this transaction on 31st year in 31st December 2001? Okay, we have the marker highlighted. On 1st Jan 2001, B entered into a contract with a customer, specialized building, for consideration this one plus bonus this amount. If the building is completed within 18 months, then they will get the bonus. Now estimated cost of construction, estimated cost is also given. This is the total estimated cost. If the contract is terminated by the customer, then we can demand for cost anchored to date plus markup. Okay, this is the point you have to consider. And then on 1st Jan 2001, as a result of the factory outside of its control, such as the weather and regulatory approval, B is not sure whether the bonus will be achieved. Now on 31st December 2001, B is still unsure whether the bonus target will be met. Now B decided to measure the progress toward completion based on cost anchored, and cost anchored on the contract is this amount. Okay, so the question is that how you will recognize the revenue for the B company if you have situation like this. The first thing you have to know that here is specialized building. This means that your performance obligation is specialized. Specialized building. This is your performance obligation, and this is single performance obligation. Now we have studied that if you have to there is a special specialized asset, the creation of specialized asset without any alternative, then that will the revenue definitely that revenue should be satisfied, the performance obligation will be satisfied over time. So it will be satisfied over time. So it's about revenue recognition and how you recognize it. So it was satisfied over time, so the revenue should also be recognized over time. Now by this asset is this building is specialized with no alternative use, so that is why we say that the obligation is satisfied over time. The second thing is that Becker demand payment for the cost anchored plus this one. So this means that B has right to payment for work completed to date. So the first one is specialized nature of the asset, and the second one has right to the payment. So this means that the performance obligation is satisfied over time. Clear? Now let's talk about the bonus. If you see here, the consideration of 2 million. This is the PEX consideration plus bonus, and the bonus is variable consideration because it depends on the future, and the amount is not clear that whether you will receive the bonus or not. So this is the bonus of 0.45 million is variable consideration, since B is unsure whether the bonus will be achieved due to external factor. You see here, to be achieved due to weather and regularity approved, and the bonus should not be included in the transaction price. So for the variable consideration, we have studied that variable consideration, let me write here, for variable consideration we have studied that it should only be included in the transaction price when it is highly probable, that significant reversal of recognized revenue will not occur. So here the variable consideration of bonus of this amount should not be included in the transaction price because this is not highly probable that there will be not a reversal of recognized revenue. Okay, so this is all about the variable consideration. So this 0.4% should not be included in the variable consideration. Now revenue recognition. Revenue recognition. If you see here that this PO, performance obligation, is satisfied over time, and I have discussed that what is the reason that why it's satisfied, and the method they are using is the progress method. They are using is toward the completion date. So this means they are using input method. Clear? Now let's calculate. Let me use this here. Okay, cost incurred to date. Cost incurred to date was how much? This is 1 million. Okay, and total cost, estimated cost was 1.5 million. Clear? Now cost recognition. Is simple. So cost to be recognized is 2 multiplied by 3 of total estimated cost of $1.5 million. So it will be 2.3 multiplied by 1.5, and then you will have this amount. This is your cost. Now okay, now your gross profit. Your gross profit will be for the year 31st December 2001, I think, and that is revenue less cost And about revenue, we have here, let me, you see here that cost anchor to date plus 30%. So cost anchor to date was 1 million plus 30%, then it will be 1.3 your revenue. Clear? So the revenue is 1.3 and the cost we have calculated is 1. So the gross profit will be 0.3 million. So in the nutshell, your revenue to be recognized 1.3, cost to be recognized 1 million, and then gross profit is 0.3 million. Okay, so this is the question of B. Clear? Now let's move on. We have a very interesting concept, another interesting concept, and that is recognizing revenue at a point in time. Clear? Okay, first let me explain and then we will check here. Okay, here recognize revenue at point and time. Now you will do this when the revenue is not recognized over time. If it's not recognized over time, then it means you have to recognize that with the point in time. And by point and time, we means that control transferred to customer of the promised goods and services. Now how you will know that control is transferred? The first thing is that customer can direct the use of asset. If you have seen something like this, then it means the control is transferred. And the second thing, that the customer obtain the majority of remaining benefit from the asset. So it means that the control is transferred. Now the second thing that will indicate that the control is transferred, that customer will prevent others from benefiting from the asset. So if you see these two indicators, then it means that the control is transferred and the revenue should be recognized at finite time. Okay, there's some other indicator that you will also consider indicator. The first one is present right to payment. If you have right to the payment, this means that control is transferred, because the customer control the asset, and that create right to receive payment for that asset. Okay, this is the first one. Number second, legal title. Legal title means that customer is now legally on the asset. So it means that customer is controlling the asset. Clear? This is the second indicator. The third indicator will be the transfer of physical possession. So when you physically transfer the asset, then it means now this asset is controlled by the customer, and now the asset is under the control of the asset because you have physically delivered to the customer. And number 4, you have significant risk and rewards. So if you transfer the control of the asset to the customer, it means you are not bearing any sort of risk and reward, and the customer will bear the risk and reward, and the risk of rewards of damage, losses, any obsolescence. So if the entity is bearing the significant risk reward, so that means control is not transferred. If entity is not bearing any sort of risk and rewards, then they definitely means that the control is transferred. And the fifth one here is customer acceptance, and by this we means that the customer had accepted the asset, and when the customer accepted asset, it may be explicitly or maybe implicitly. So these are the 5-6 indicators that will show that the control is transferred. Clear? Now let's check it here. Okay, you see here, when a performance obligation is not satisfied over time, then revenue recognized at a point in time, which means is when the customer obtain control of the promised asset. So when the customer obtain the control of the promised asset, this means that control is transferred. It means that asset is transferred, and you have to recognize revenue at a point in time. Now the transfer of control. By transfer of control, we means that the customer can direct the use of the asset and can obtain majority of the remaining benefits from that asset. And it also includes, so they can prevent others from benefiting from that asset. Now here is some indicator. The first one is present indicator that the control is transferred. So one is present right to payments. This means that the entity has the right to receive the payment for the asset, which indicates that the customer has control over the asset. Clear? Now the second one. The second one is legal title. And the legal title means that the customer has now ownership, legal ownership or title of the asset, which is the strong indicator that the control has transferred. Transfer of physical possession. This means that the asset is physically delivered to the customer, and now the customer has the possession. The customer has the control. So this is also means that the control has been transferred. Now, significant risk and reward. So the customer has assumed a significant risk and rewards associated with ownership of assets such as risk or loss. So when the entity bearing the risk and reward, then we record that a control is not transferred. As the significant risk and reward is bearing by the customer, mean they are taking risk of loss in a damage, then this means that the control has been transferred. Now let's see here the customer acceptance. This is the fifth one we have discussed. It's if customer has accepted asset either explicitly or implicitly, then acceptance means emper from the user or the failure to object to the fact. So when the customer accepts the asset, that means that control is transferred. Now key point in this recognition at point in time is that when any or combination of these indicators suggests that the control has transferred, then the point in time is when the customer is direct the use of the asset and other obtained benefits. So you have to recognize the revenue using the point in time. Now here we have a question, and this question is clearance. Okay, here should clients recognize revenue from the above transaction in the year in 31st December 2001? Clear? Now on 1st December 2001, C delivered a January edition of magazine, okay, with a total sale value at this amount, the supermarket chain. The legal title remained with the C until the supermarket sale to the end consumer. Supermarket will start selling the magazine on 1st January 2002. Any magazine that remain unsold by the supermarket, unfortunately, will return. So this is the return, right to return to the C. And supermarket invoice principal based on the difference between the number of issue they receive. So mean there is a risk and reward issues. Okay. So the question is that should the C, we have to advise that should the C recognize the revenue from the above transaction or not? Clear? So the first thing is that C delivered the January edition of magazine, and this shows that performance obligation, the magazine sale as a point in time performance obligation. Why? Because C satisfied this obligation when the control of the magazine is transferred to the supermarket. Clear? So the physical position is with C. With the supermarket. So they have just transfer. This is the PO, and that will be time, point in time. Now, indicator of control transfer. Let's talk about indicator of control transfer. Okay, so while the supermarket has physical possession of the magazine, so this magazine has been transferred. So it means that the physical position where the supermarket on 31st December 2001. Clear? This alone is not enough to determine the control is transferred, because we have to consider some other factor that we have discussed. Some legal title, transfer of physical position is okay, fine, and then present right to payment, the significant risk and reward, customer acceptance, direct use of the asset, majority of remaining benefit from it. So there's a lot of indicator we have to consider all. Okay. Now, the first one is legal title. So the legal title remained with the C. This is in favor of C. That means that control is not transferred. Now, so the legal title remained with the C until the supermarket sell the magazine to the end consumer, which indicates that the control has not fully transferred. Now, the second indicator is right to payment. So you see here, the client has no right to receive payment from the supermarket until the magazine are sold to the end customer. So means that they will not take any, they will not receive any money until the magazine are sold to the to the end consumer until the guitars remain with until the supermarket sell the magazine to the end consumer, and they don't have the right because there's some return option. So this indicate that the indicating that control is not transferred. And then return rights. If you see here, if there any magazine that remain unsold by the supermarket and the purchasing are returned to the clearance. This means that any unsold magazine are to be returned to the clearance, indicating that the clearance still bear the significant risk, including the risk of obsolescence and unsold inventory. So the conclusion will be that clearance retains the significant risk and does not have the right to receive the payment until the magazine are sold. Control has not transferred to the supermarket on the 31st December 2001. On this day, the control is not transferred. So therefore, C should not recognize revenue for the magazine delivery and the financial statement for the year ending 31st December 2001. Clear? So we have not to recognize revenue because control of the asset is not transferred. When the control is not transferred, then definitely you will not recognize the revenue. I think this is yeah, this is for today enough. Inshallah, we'll continue in the next lecture. We'll do some there's a consignment, arrangement, and some other uh, topic, short topic, repurchase agreement. So we will do all these one by one. Thank you for watching.